In 1928, a Russian economist named Nikolai Kondratiev made a prediction that would get him killed. He told Soviet officials that capitalism would experience a massive collapse within 2 years. Not eventually, not someday, within 2 years. Stalin's government didn't want to hear it. The Soviet narrative was that capitalism was already dying, while communism would bring permanent prosperity. Kondratiev's prediction directly contradicted the state propaganda. But here's what made his prediction truly dangerous. He wasn't guessing. He had discovered something. A mathematical pattern hidden in 150 years of economic data. A cycle that repeated with clockwork precision. A wave that moved through economies like the seasons move through the year. Spring, summer, autumn, winter. Growth, boom, stagnation, collapse. And his model said winter was coming in 1929. Stalin had him arrested in 1930, sentenced to 8 years in a labor camp. In 1938, during the Great Purge, Kondratiev was tried again, sentenced to death, and executed by firing squad on the same day. He was 46 years old. But before he died, his work had already escaped Russia. His book, The Long Waves and Economic Life, had been translated and distributed in the West. Other economists studied his data, they tested his model. And on October 24, 1929, exactly as Kondratiev predicted, the stock market crashed. The Great Depression had begun. The cycle was real.
Fast forward to 2008, most people didn't see the financial crisis coming, but a handful of economists who understood Kondratiev's work weren't surprised at all. The cycle pointed directly at 2008, 50 years after the 1950s recovery, right on schedule for another winter phase. The subprime mortgage collapse, Lehman Brothers scaling, the entire global financial system nearly imploding, the Kondratiev wave had struck again. And here's what should terrify you. The cycle is pointing at 2026, not as a possibility, as a mathematical certainty. The wave that predicted 1873, 1929, and 2008 with terrifying accuracy is screaming that we're about to enter another winter phase. And this time, it might be worse than all of them combined.
Before we go deeper into what's coming and why 2026 specifically, I need you to do something. If you're finding this information valuable, hit that subscribe button right now. Click the bell icon so you don't miss what happens next, and drop a comment below telling me where you're watching from and what time it is where you are. I'm genuinely curious how far this information is spreading. Are you in New York, London, Singapore? Let me know. This kind of analysis doesn't show up in mainstream financial media. They're not going to tell you what's really coming because their job is to keep you calm and invested. My job is to show you the patterns they don't want you to see. So subscribe, hit the bell, drop that comment. Now let's talk about exactly what Kondratiev discovered and why it matters right now.
Nikolai Kondratiev wasn't working with theories or speculation. He was a statistics analyst. He collected economic data going back to the 1780s. Commodity prices, interest rates, wages, production volumes, foreign trade statistics, bank deposits. Hundreds of data points across multiple countries and more than a century of economic history. What he found was stunning. Long waves, economic cycles that lasted 40 to 60 years. Not the short business cycles everyone knew about, the ones that lasted 7 to 10 years. These were massive super cycles that governed the rise and fall of entire economic eras. Each cycle moved through 4 distinct phases, just like seasons. And once you understood the pattern, you could see it everywhere. Let me walk you through how this works, because understanding the cycle is the only way to survive what's coming. The cycle begins with spring. This is the recovery phase after a major crisis. Winter has destroyed the old economy. Bad debts have been liquidated. Zombie companies have failed. Asset prices have crashed to levels that actually make sense. Survivors emerge from the rubble and start rebuilding. New technologies that were invented during the previous autumn and winter phases finally become economically viable. Infrastructure gets rebuilt. Optimism returns, but it's cautious. People remember the pain of winter. They're careful with debt. They save. They invest in productive assets. Interest rates are low because there's little demand for credit. Inflation is modest because excess capacity exists everywhere. This is a healthy, sustainable growth phase. The 1950s were a perfect example. After World War II and the Depression of the 1930s, America rebuilt. The interstate highway system connected the country, suburbs expanded, television became mainstream, the economy grew steadily, but nobody was getting reckless. Savings rates were high, debt levels were low. It was spring.
Then comes summer, the boom years. The technologies introduced during spring mature and spread throughout the economy. Everyone who is cautious during spring starts feeling confident. Employment is high, wages rise, people feel wealthy. The stock market climbs year after year. Inflation starts picking up because demand is finally outpacing supply. Credit becomes easier to obtain. Debt levels rise, but it doesn't feel dangerous because everyone's making money. This was the 1960s, the space race, the golden age of American manufacturing. Unemployment below 4%, wages rising faster than inflation, home ownership reaching all-time highs. Everything felt permanent. Everyone believed prosperity was the new normal. But beneath the surface, problems were developing. The debts being accumulated would eventually need to be repaid. The inflation being generated would eventually need to be controlled. The seeds of autumn were being planted even as summer blazed at its brightest. Autumn arrives next. This is the plateau phase, and it's the most dangerous period of the cycle because almost nobody recognizes it for what it is. The peak has been reached, but the momentum from summer creates an illusion that growth will continue forever. The reality is different. Real economic growth starts slowing, but this gets masked by inflation. Corporate profits look strong, but they're not growing in real terms. Asset prices become completely detached from underlying fundamentals as speculation replaces investment. Everyone's chasing returns. Central banks, seeing inflation accelerate, start raising interest rates to cool things down. This slows the economy even more, but people keep borrowing anyway because they believe the boom will return. Debt accumulation accelerates dramatically during this phase. Governments borrow to maintain the illusion of prosperity. Corporations borrow to buy back stock and pay dividends rather than invest in productive capacity. Consumers borrow to maintain living standards even as real wage growth stalls. This was the 1970s and early 1980s. Stagflation. High inflation combined with minimal growth. Oil shocks that revealed how fragile the prosperity of the 1960s really was. Interest rates rising from 4 to over 15%. Unemployment climbing. The economy felt stuck because it was stuck. Autumn had arrived. The cycle was transitioning toward winter, but the Fed thought they could prevent it with monetary policy. They couldn't. All they did was delay winter by a few years, which made it worse when it finally arrived. Winter is the crisis phase. The accumulated debt becomes unpayable. Asset bubbles pop, banks fail, credit markets freeze, unemployment spikes, deflation takes hold, or at least a severe recession. This is the Great Reset, where all the excesses of the previous three phases get purged from the system. Businesses that survived on cheap credit go bankrupt. Over-leveraged investors lose everything. Asset prices fall 50, 60, sometimes 70% from their peaks. Only those who prepared for winter, who held cash and stayed out of debt, survived to buy assets at depression prices. This was the early 1930s, the Great Depression that Kondratiev predicted. Thousands of banks failed. Unemployment hit 25%. The stock market fell 89% from its 1929 peak. It took 25 years for stocks to recover to 1929 levels in real terms. That's a true Kondratiev winter, a complete cleansing of the system, a destruction of wealth so severe that an entire generation learned to fear debt and speculation.
But the cycle doesn't stop there. After winter comes a new spring, the 1950s, as we talked about, then summer again in the 1960s, autumn in the 1970s through early 1990s, and winter arrived right on schedule in 2008 with the financial crisis. But here's the critical point that changes everything. The 2008 crisis should have been worse, much worse. It should have been a full Kondratiev winter that cleansed the system completely. Instead, governments and central banks intervened with unprecedented force. They bailed out banks that should have failed. They dropped interest rates to zero. They printed trillions of dollars through quantitative easing. They prevented the natural winter from running its course. What they actually did was delay winter, not cancel it. And that means the winter that was supposed to fully unfold in 2008 through 2010 is still coming. It's been postponed for 15 years through artificial monetary policy and massive debt expansion. But you cannot postpone winter forever. Eventually, the accumulated imbalances become so large that no amount of intervention can prevent the correction. That point is approaching now. 2026 sits at the intersection of multiple cycles, all pointing toward the same conclusion. The delayed Kondratiev winter is finally arriving. Let me show you the specific evidence, because this isn't speculation. This is mathematics and historical pattern recognition. The original Kondratiev wave had an average length of about 50 to 60 years from peak to peak. The last major peak, the point where autumn transitions to winter, occurred in the late 1960s. Add 50 to 60 years to that, what do you get? 2020 to 2030. We're in the window right now. But there's more precision available if we look at the subcycles within the long wave and the current economic data.
The debt supercycle that overlays the Kondratiev wave suggests that maximum debt saturation occurs roughly every 70 to 80 years. This is the point where the system can no longer absorb additional borrowing without breaking. The last time this happened was in the 1930s and 1940s, during the Depression and its aftermath. Add 70 to 80 years, you get 2010 to 2020. We've passed into the danger zone. Global debt right now sits at 235% of world GDP. Let that sink in. The world owes 2.35 times its annual economic output. In the United States alone, federal debt crossed $38 trillion in October 2025. That's 125% of GDP, the highest level since World War II, when debt hit 119%. We're already in unprecedented territory for peacetime debt levels. But there's another cycle at play here that makes this even more precise: the generational cycle. Every 80 to 90 years, roughly the length of a human lifetime, societies forget the lessons of the previous crisis. The people who lived through the Great Depression and understood its causes are gone. My grandparents' generation, the ones who saved every penny and refused to carry debt because they remembered the 1930s, they're dead. The current generation has no lived experience of true economic catastrophe. This creates the psychological conditions for repeating the same mistakes. The last generational crisis peak was 1929 to 1933. Add 80 to 90 years, you get 2019 to 2023. The timing is precise. These cycles don't operate in isolation. They reinforce each other. When multiple cycles align and point toward the same time period, the resulting crisis is exponentially more severe than if only one cycle were turning. Right now, we have the Kondratiev long wave, the debt supercycle, and the generational cycle all converging on the same window, 2022 to 2027. Within that window, the most likely flashpoint based on sub-cycle analysis and current economic indicators is 2026. Not the beginning of 2026, not the end, but somewhere in the middle, late spring or early summer of 2026, when multiple stress points in the system reach critical mass simultaneously.
Let me show you why 2026 specifically, because there are leading indicators within these cycles that help pinpoint timing with remarkable accuracy. The first indicator is the yield curve inversion. This is when short-term interest rates rise above long-term interest rates. Every recession since 1950 has been preceded by a yield curve inversion. No exceptions, no false positives. The yield curve inverted in July 2022. It remained inverted for over 2 years, one of the longest inversions in history. Then it finally uninverted in September 2024. Historically, recessions begin 6 to 18 months after the curve uninverts. September 2024 plus 6 to 18 months equals March 2025 to March 2026. That's your window.
The second indicator is corporate credit spreads. This measures the difference between what safe borrowers pay for loans versus what risky borrowers pay. When spreads are narrow, investors aren't worried about risk. When spreads widen dramatically, it signals investors fleeing to safety. Spreads always widen sharply right before major economic downturns. Right now, spreads are beginning to widen after years of remaining compressed. The widening started in late 2023 and has been accelerating through 2024 and into 2025. Based on historical precedent, spreads begin widening 12 to 24 months before the crisis hits. Late 2023 plus 12 to 24 months equals late 2025 to late 2026.
The fourth indicator, and this is the big one, is commercial real estate. There is approximately $1.5 trillion in commercial real estate loans that need to be refinanced between 2024 and 2027. The peak refinancing wall hits in 2025 and 2026. Over $930 billion in commercial loans mature in 2026 alone. That's more than triple what matured in 2024. These loans were originated when interest rates were 2 to 3%. They're being refinanced at 6 to 7%. The buildings can't support the higher debt service. Defaults are already climbing. In the first half of 2025, lenders recorded nearly 150 commercial real estate foreclosures, the highest mid-year total since 2014. And that's just the beginning. The refinancing cliff is steepest in the first and second quarters of 2026. When commercial real estate defaults reach critical mass, regional banks fail. When regional banks fail, credit markets freeze. When credit markets freeze, the broader economy collapses. We've seen this movie before in 2008. Commercial real estate was at the center of that crisis too. But this time, the problem is bigger. The amount of debt is larger. The interest rate shock is more severe, and banks are already weakened from the 2023 regional banking crisis. They don't have the capital cushion to absorb large losses.
But let's zoom out to the bigger pattern. Because what makes the coming 2026 crisis potentially worse than 1929 or 2008 is something economists call the everything bubble. Normally, bubbles form in one sector. Real estate in 2008, technology stocks in 2000, the stock market in 1929. But the intervention after 2008 didn't just inflate one bubble, it inflated everything simultaneously. Stocks hit all-time highs, bonds hit all-time highs, real estate hit all-time highs, cryptocurrencies appeared and created their own speculative mania. Even art and collectibles reached absurd valuations. Everything inflated at once because the Federal Reserve was pumping money into the system at unprecedented rates. Zero interest rates for 7 years, $4 trillion in quantitative easing, then another $5 trillion during COVID. The money had to go somewhere, so it went everywhere. This creates a unique problem. When everything is in a bubble, there's nowhere to hide when the bubble pops. In 2008, if you owned bonds, you were okay. In 2000, if you owned real estate, you were fine. In 1929, if you waited a few years and bought bonds, you eventually recovered. But in the coming crisis, everything deflates together because everything was inflated together. Stocks, bonds, real estate, crypto, commodities, all falling simultaneously. This is what makes 2026 potentially the worst Kondratiev winter in history. The interconnection and correlation across all asset classes is unprecedented. The Federal Reserve is trapped. If they keep rates high to fight inflation, they crash the economy and cause a wave of defaults. If they lower rates and print money, they reignite inflation and destroy the currency's purchasing power. There's no good option. They can choose pain now or catastrophic pain later. Based on historical precedent, central banks always choose to delay pain, which makes the eventual crisis worse. The Fed will likely continue cutting rates through 2025. This will provide temporary relief. Markets will rally. People will think the worst is over. But this will be the final bubble before the burst, the last gasp of artificial prosperity before the delayed Kondratiev winter finally arrives in 2026.
Understanding this cycle isn't about predicting every twist and turn.
It's about recognizing we're in the late stage of a major cycle and positioning accordingly. The people who understand Kondratiev winters don't try to time the exact top. They prepare early. They build cash reserves during the autumn phase. They avoid debt. They don't chase speculative assets just because everyone else is making money. They accept short-term underperformance in exchange for long-term survival and the opportunity to buy assets at depression prices during the winter. History shows that those who position correctly before a Kondratiev winter can achieve generational wealth. The investors who bought stocks in 1932 and 1933 at the depths of the Depression saw returns that would never be matched in normal times. A dollar invested in 1932 would have grown to over $100 by 1950. The investors who bought real estate at foreclosure prices in 2009 and 2010 created fortunes. Properties purchased for 30 cents on the dollar in Phoenix, Las Vegas, Miami, they're now worth 3 or 4 times what people paid. The opportunities that appear during Kondratiev winters don't come around often, once every 50 to 80 years. If you're prepared, if you have capital when everyone else is desperate, you can acquire assets at 20 to 30 cents on the dollar. Those assets eventually recover, that 20 cents becomes a dollar. That's a 500% return. But preparation requires going against every instinct and ignoring all social pressure. Right now, in late 2024 and early 2025, everyone seems to be making money. Your neighbors are talking about their investment gains. Financial media celebrates new market highs. Experts say this time is different, that technology has changed the old rules, that AI will create permanent prosperity. Staying liquid and cautious feels like missing out. This is the test. The people who can resist the temptation to chase returns during autumn are the ones who survive winter and thrive in the next spring.
The hidden cycle that predicted 1873, 1929, and 2008 is pointing at 2026. The mathematics are clear. The historical precedents are documented. The warning signs are visible right now in commercial real estate, in credit spreads, in consumer confidence, and the yield curve. The only question is whether you'll prepare while there's still time or whether you'll wait and hope the cycle is wrong this time. Nikolai Kondratiev died in a Soviet labor camp because he told the truth about what was coming. His cycle has been right for 200 years. Winter is coming. The only question is whether you'll be ready when it arrives.